It's
game time, brother.
It's game time because we are live on Facebook for the Thursday edition of the Not Your Average Investor Show. Today, as you know, if our regulars know that Thursday is about you. It is about your questions. It's about answering the things that have been burning inside of you about property investing in rental properties and property management. And as a result, we do a property breakdown, a deal of the week, so we can really dive into the numbers, give you as much value as possible. I'm your host, Pablo Gonzalez. My co-host is the property breakdowner of property breakdowners, but he's a real upper to be around all the time. So don't let the downer fool you. I'm reaching here, Greg.
Wow.
Greg Cohen, co-founder of JWB. How are you, buddy?
Man, you had me on an emotional roller coaster about myself. I heard downer, but no. I am an upper. So I don't know. I'm somewhere in between.
That's what happens for anybody that's joining us new today. About 3 weeks ago, Greg called me out because every time I would say the amazing Greg Cohen, and he started prompting me to come up with new adjectives. So now I'm trying to come up with new different ways to introduce him, and they're not always better than the last one. I think
this is fun. I think this is a good way to get it going. You know, we prepare, obviously for the show in advance, but that's like off limits to prepare for. There's no way that we're allowed to tell each other how we're going to intro this thing. So I'm looking forward to next week too.
Me too. So for those of you joining us for the first time, welcome. Super happy to have you today. For our regulars, welcome back. Thursday is like a chat amongst friends, right? We really enjoy this. And Tuesdays is the day that we interview people, and that is a different format. But for all of these, we want this to be as interactive as possible. We want you to chat with us. We want you to chat with each other. There's two ways of doing that. You hit that chat button, and you can talk to us and talk to other people as long as you hit that drop-down menu and change it from all panelists to all panelists and attendees. And I recommend that you do that so that maybe you make a new friend. Lee Bishop will definitely talk back to you in the chat, and he's a great guy to know. Also, if you want a question asked here on the show itself, you can do it in the chat, but I may go cross-eyed because I got a lot going on. So the easiest thing is to pop open the Q&A box and pop it in there, and I will definitely do my best to get to it in this time. And apart from that, if you want to know the basics of rental income investing, you want the free investor toolkit that Greg has put together. You want to look at a comparison of 4 properties that are out there so you can compare numbers. Go to jwbwebclass.com and spend a little quality time listening to the wisdom of the Greg Cohen, the upper Greg Cohen, and you'll have a good time there, right? So we recommend that anybody here the next logical step is to go to JWB.
I'm
losing here, bro. I'm losing here. I don't know what's going on. Are we in Mercury retrograde here or something like that? jwbwebclass.com. That's where you want to check that out. And without further ado, you've listened to me bumble around and mess up my words as possible. We want to bring you the hottest segment on the internet right now, the JWB Property of the Week. You ready to break it down, Greg?
We need some sound effects coming from there. Like it needs to like reverberate your property of the week. There we go.
Who needs sound effects? Who needs sound effects when we got you, buddy?
There we go.
There you go. So where are we going? We're going to San Juan. Little beautiful place in Puerto Rico, also a street here in Jacksonville. Greg, you wanna tell us a little bit about this property? This looks like a new construction. You wanna talk about that?
Yeah, and I noticed we have a lot of new clients that are jumping on right now, and the purpose of what we're doing here is a lot of our clients and new potential clients have been reaching out and saying, "Hey, I want to see more of your inventory." And so this Thursday show that we're doing now is where we focus on the property of the week. And so I choose a property that we currently have available right now. And we use it as an opportunity, obviously, for those of you who are ready to invest, this one's available and that you can reach out to the team and we could start that process. But for those of you who are not, this is a great learning experience. There's nothing like the tangible kind of process of looking at an individual property to get your mind right, get yourself in that kind of trial mode and make sure that the questions that you have are answered. So that's really what we're hoping to accomplish here. And this one on San Juan Avenue is one that I really love, of course. There's a lot to like about it. I think we'll first start with The thing that's most visible right here, the picture, right? This is brand new construction, right? We talk a lot about brand new construction here at JWB. It's something that we have become known for. We started brand new construction as this build to rent phenomenon all the way back in 2011. And it's been this wonderful, experience for residents, for clients. Overall, it's been a great thing. So we can talk a lot about new construction. We can also talk about renovations as well. This one is not a renovation, but I want to make sure people know that we love renovations too. It's not only new construction. So I thought the best thing to do would be to point out some of the pros and maybe some of the cons is maybe not the right word, but some of the advantages of new construction over renovations, and then some of the advantages of renovations over new construction. Kind of start there.
Okay. Sounds well. So when I think of advantages, like I'm looking at this thing, and what really popped out to me is I normally expect the return of the properties that we show to be in the like 260, 280, high 200s. I think this is the first one that you've shown me that is a $300 plus estimated cash flow with conventional financing. You want to start there?
Absolutely. $300 for a conventionally financed purchase is really tough to achieve, like Pablo's talking about here. So let's talk about how we get there. All right. So for new construction, one of the things you're going to notice as new construction that most people don't think about when it comes to cash flow being generated for you, everybody pays attention to the rent. And we'll get to why we have such a high rent here in a second. But you also need to pay attention to your expenses, right? One of the expenses that you see that's much lower on brand new construction is your insurance cost. So if you go over to the left a little bit there, Pablo, you'll see that our insurance cost on here, it's only $400 a year, right? That is incredibly low, but that's what you get with brand new construction. You know why that is, Pablo, why it's lower for brand new construction?
I would assume that it is up to snuff with hurricane, and there is, with hurricane codes and the roof and all the new, Florida's gone through a big re-upping of codes since Hurricane Andrew.
Exactly. That's right. I mean, at the end of the day, the reason why we get a lower insurance premium here is because the insurance company assumes that there's less risk for this asset. And the reason is because of the building codes. Because of the standards of construction today versus what they were when the house was built in 1940 or 1950, the insurance companies take less of a loss on new construction, and they pass that along to homeowners like you and me in the form of lower insurance premiums. So just because you're buying new construction, you're going to see lower insurance costs. This is one of the advantages of new construction over renovations, right? A $210,000 renovation is going to have a higher insurance premium, might be somewhere around $700-800 a year, right? You get half of that here for this brand new construction home, which is one major way that we're able to build that cash flow number up, and we get it over $300 a month there.
That makes a lot of sense, Greg. So I don't imagine that that's the full driver of that extra value, right? I'm seeing a pretty high estimated rent range here as well, right?
Absolutely. So you get a premium for new construction, right? You get a slight premium for what the home will rent out because it's new construction, right? So that's one reason why you're driving that. Anytime you can get rents above $1,500 in our cash flowing neighborhoods in Jacksonville, that's really strong, right? So, and obviously this is a neighborhood that we know and love here on the west side of Jacksonville. We could put a map up here where you would see literally probably 20, 30 properties right within a half-mile radius of ones that we've either built or renovated and managed. So it's in our bread and butter. So it's just tough to find $1,500 rents, and you do that generally through a new construction property.
Okay. I also see this price is a little high, right? Like normally I'm used to seeing houses right butting up to the 200s, but I normally don't see it at 210 as well. Is that why the rent is so much higher, or what's that relationship?
So let's talk about this, and let's compare it against the backdrop of renovations, right? Your goal as an investor is obviously to use your money as wisely as you can to achieve the best risk-adjusted return on investment, right? So in order to do that in rental properties, you have to get high income, which is your rent, and you have to lower your expenses. And then that's a factor of how much money the property costs, or more importantly, what your down payment is, right? So if we're looking at this and we're comparing this for a new construction house versus a renovation, new construction is going to win on a couple of things. New construction is going to have lower insurance costs, like we just talked about, and new construction is generally going to have slightly lower maintenance and vacancy costs as well. And all of those really contribute to a better return on investment. Now, new construction versus renovations. Do you think generally new construction is more expensive or less expensive, Pablo?
I would say price point of the property. I would say new construction is probably more expensive.
Yeah, makes sense, right? If you can get a premium for your rents that you're getting, you're also getting a premium for the price of the property as new construction, right? Other properties in that area that are new construction are selling at what the market value is, which is generally a little bit higher than what renovated homes would be. So you're looking at this and you're saying, well, 210,000, that's near the most expensive property that JWB is going to sell, right? Why does that make sense? Well, we need to make sure that we're trained as investors, right? Our job is to deliver return on investment for our money, right? So the only way you should look at a property that's $210,000 and say that that is where you should be, investing, is if that property can deliver strong cash flows, if it can deliver a high rate of rental income and lower expenses. And then when it can do that, then you're in business, right? Then that $210,000 is a factor of your overall return on investment, which is kind of what we see here. Almost 11% returns. We haven't seen too many of those, have we, Pablo?
Haven't seen a lot of that. No. But
No.
this is, so I guess that begs the question, right? Like I've over the past couple of weeks, the first time I saw it go over 10, I kind of blew my mind, right? Now I'm getting a little bit more used to it, but I think there is value in explaining why you've gone from this like preaching 7 to 9% to now you're preaching 9 to 11, right?
Yeah, exactly. And that's the effect of interest rates on rental property investing. We have been talking about how important it is to use debt smartly and responsibly. And we were doing that when interest rates were 5.5%. For everybody out there, I'm sure you've heard by now that interest rates are literally the lowest that they've ever been on record. So the cool thing is through our evaluations, you can see the tangible effect of low interest rates on your return on investment like that, right? When we dropped our estimated interest rate for our clients that they would get with financing from about 4.5% down to 4%, which is where it is right now, that instantly had a 2% increase on return on investment, which is huge. So for the longest time, for all of our clients, many of our clients who are on the call right now, you all are purchasing properties are earning between 7 to 9% estimated returns on investment from the cash flows. Well, now that same property, because your interest rates are so much lower, is now generating between 9 to 11%. And that's really kind of where we're at now.
And that's the great opportunity that we're in right now, right? Like we've talked about that at lengths in the past show. This is like rewind the clock and knowing that there's going to be a window where you can lock in forever elevated returns. And this window at some point will go away and you'll be like, man, why didn't I buy property in 2002?
Right? Yeah. I mean, if you look at the return on investment, it's almost like an opportunity to go back in time and to buy properties at a price. If you kept the price lower, but the interest rate was 5.5%, you'd wind up at the same return on investment. You'd wind up at the same, generally the same cash flow numbers. I'm generalizing here, right? But it's interest rate, it's return, it's cash flow, it's, your purchase price. Those are all relative. So, you can look at this and say, you could have purchased properties that had a lower purchase price years ago at a 5 or a 5.5% interest rate and be at the same place that you're seeing right now, right? Maybe a 9%, 10%, 11% overall return on investment. So it has a dramatic effect on your ability to acquire properties, earn positive cash flow today. And then I think more generational wealth is going to be created because of these low interest rates than, I don't know, name a time period in the past, right? You come up with the time period. But the point is right now is a huge opportunity for those who can put themselves in a position to take advantage of the smart debt. Your overall financial picture is really, really going to benefit from it 5 years down the road, 10 years down the road, because it's not going to be this way forever.
That makes a lot of sense. And we're getting their first user-generated questions. Thank you, Marilyn. Thank you, Gerard. And right on time with what I was going to ask. For a home like this that is 210, what is the down payment for this one? And is there generally like a percentage down payment that you're putting in for these homes? And how would you advise people to, that's really all we got to say. Marilyn and Gerard want to know, what the down payment is and what the percentage for down payments are.
Yeah, absolutely. So you have a couple of options with your down payments. on our property evaluations, we assume that you're putting 25% down because we're very conservative. So that's how that 11% return is generated. It's assuming that you're putting 25% down. If you put 20% down, it would instantly jump up the estimated return on investment. So yeah, this is great. Why don't we zoom in really to the top there and you see where that financing assumptions box is? Yeah, perfect, right there. So these are the assumptions that this is built off of. One of the cool things, sometimes new clients or new potential clients ask us if they can use our property evaluations and plug their own numbers in. And the answer to that is absolutely yes. We make these available for everybody on our site. And you can use this. You can use this as your own investment calculator. And you can just plug and play. So like, Pablo, let's change that 25% down payment to 20% and see what happens here. All right, go all the way to the right.
As I'm doing this, Greg, this is what you receive in the investor toolkit, right? At JWB Web Class?
Exactly. Yep.
Cool.
You get our property evaluations as well as this property investor calculator.
Cool.
So, but you can see our total ROI just jumped up, right, to 12.5%. It was under 11%. So no, this is another example of JWB being conservative. We are assuming that you're putting 25% down. What you'll find with other turnkey providers is they're so much trying to get the highest return on investment. They're to the detriment of can they actually perform at that, and so they'll put 20% down and make that same property look better versus our conservative approach there.
So Greg, let me ask something. If your ROI goes up by putting 20% down, why would I want to put down 25%?
Well, it's a good question. So we always go through this with our clients. And, before you purchase, we're going to sit down, we're going to work on your buying plan. If you're a current client, we already know what your buying plan is. You're already speaking with our portfolio managers. So it's a different decision for those. But yes, to your point, the best return on investment is to put the least amount down. So 20% would, increase your return on investment. However, there's a couple other caveats. So your interest rate that you are able to get will be lower the higher you put down. So we talk to folks about that. Is a slightly lower interest rate for you more important, right? Or is the best return on your investment more important, right? And, and then there's other people's comfort with debt level. Some people come in and say, listen, I don't want to be more than 75% leveraged, so it's some of it's a little bit of a personalized decision. But your point is extremely valid, which is if you put 20% down, then you're going to see a higher return on your money because your down payment is lower. And then just to point out a couple of things, I know the question was, how much down is this? Well, $52,500 if you're putting 25% down is what you would expect. But we do need to estimate closing costs as well. This is another thing that is kind of a gotcha moment for a lot of turnkey investors out there. Very few turnkey companies out there include the closing costs in their return on investment. So if you'll zoom in a little bit and go over to where it says total initial investment to the right of where you are, Pablo. Yeah, zoom in there for where it says rental assumptions. Yeah, there you go. So check this out. So this is another trick that a lot of turnkey companies use, that they don't factor in all of the costs, right? That estimated closing cost is what we expect for your costs to be, right? There's always origination fees and title fees and whenever you buy real estate, right? Well, that's a part of your initial investment. Most turnkey companies don't put that in there. Pablo, if you delete that $5,250 out of there, check this out. It bumps your return up as well, right? But is that real? No, it's not real, right? But this is what a lot of investors fall victim to, right? They get an artificially inflated return on investment that company can't hit it, and you know how that drill goes.
That makes sense. Rob Jones is asking, he thought that most mortgage companies will not loan with 20% down, that require 25% down. Is that true?
No, I'm glad you asked that question, Rob. That is not true. 20% is very normal.
All right. Did I cut you off? Were you saying something, or do you want me to keep going here? I got more questions for you.
Well, I was going to point out what the down payment amount would be if you put 20% down, okay, just for folks to see there. So you're looking at $42,000. So think somewhere around for this property, $50,000 to $60,000 down is what you would be putting into this property. And another point here, so many investors, we spend a lot of time focusing on return on investment, right? Making this objective decision the right way. So many folks look at a purchase price of a property, and that is one of the guiding principles as to whether or not they should invest. That is a part of the equation. But for me and for our investors, you should be trained to look at return on investment, right? When you see a $210,000 property that is delivering $1,524 in rent a month and delivering an 11% return on investment, right? Your down payment, if your down payment for that property is 20 or 25%, right? So if we're thinking about the best way for us to accomplish our long-term goals, which is getting the best risk-adjusted return on your investment, right? You should be looking at your return on investment first, right? If the property is $210,000 and that is within your budget to afford it, you just got $50,000 or $60,000 of capital working at 11%, right? Now, if you put a property in front of yourself that is earning a point less, right? Call it a 9.5% return, but it cost $150,000. Which would you be more excited for, Pablo?
The one with the higher ROI.
Right, because your job is to get your capital working as the best risk-adjusted returns as possible. So don't look at a $210,000 property and go, oh, geez, that's too expensive, right? Look at the return on investment. And if you can get your capital working at 11%, get excited about it. I mean, that's the way I look at it.
Yeah, I mean, I'm excited looking at these numbers. Let me ask something else, Greg. What if I were to say this 311 monthly cash flow? What if someone was to say, yeah, but that's 311 monthly cash flow in your pocket before taxes? Like, is there a chunk that should be coming out of this 311 that you're then going to have to pay to Uncle Sam later on?
I love kind of digging a little bit deeper into this because this is a common misconception question. So let's spend a little bit of time on it. So that 311 that we're talking about right now is your monthly cash flow on a normal month for a turnkey rental property with JWB. All right. So that means that you're 3 months, 6 months, a year into owning this asset. Every single month, the rental income minus your mortgage payment, your principal, interest, taxes, and insurance, and your property management fees is going to net you $311. Okay. So what that's not taking into account, it's not taking into account tenant placement or anything like that, right? Because that's not happening in a normal month. It's not taking into account your maintenance and your vacancy costs because those things are not happening on a normal month. It's also not taking into account your other profit centers as well. It's not taking into account your tax savings. It's not taking into account your principal pay down. It's not taking into account your home price appreciation, of course, right? So that's just a normal month. That really is the dollars that will be netted to you in a normal month, right? You don't have to discount that and say, well, really, I'm going to pay a little bit more of this or whatever in taxes to Uncle Sam. That's just real net dollars that's going to you. Where the tax savings component comes in is the return on investment calculation, that 10.93% number in there. That assumes that you are incurring the taxes from Uncle Sam on rental income, which are taxed at your federal income tax bracket. And that also is assuming that you're taking advantage of depreciation from a tax perspective on the property. When we talk about the 5 potential profit centers from rental properties, one of them that's often overlooked is your tax savings component. Tax savings means getting a write-off from depreciation as well as a lot of other things when it comes to rental properties. And so short answer to all this, that 311 is real. That's coming into your bank account. Longer answer to this is that you get incredible tax savings that help offset the taxes that you do need to pay. And all of that has been included in that 11% number.
So not only is it real, but there's more coming, right? Because of taxes.
That's right. That's right.
Like
so that 11% number is including the tax. So the 11% number is including 4 of the 5 profit center. What's the profit center that it's not including, Pablo?
The 11% number is, I know, because I was literally about to ask about this. I think it's this little profit center right here, appreciation, right?
Yeah. Yeah. We were talking about this morning, right?
Yeah.
And what did you say when we were on our run this morning about home price appreciation in the profit centers?
I don't remember exactly what I said, but it was something along the lines of when I talk to people about, JWB investing, they get hung up on this like, oh, 9%, 10%, I can get that somewhere else. And because the appreciation piece of it isn't factored in, they're thinking that it's not as good a investment as it is when I'm like having a casual conversation.
Do you remember why I instantly agreed and said, yeah, I totally get why they're saying that? Do you remember the reason for why they're saying that is?
I think I was breathing too heavy at that time to really remember that.
I said, because that's what I told people. That's what I've been telling people for the longest time, right? Pay attention to the rental income, right? And so they listened to me on that, which is incredible. We do need to listen to that. But every once in a while, what you'll hear from me is I want to give you a glimpse into the real overall total profit potential of rental properties, which is the thing that made me quit my corporate job, leave every bit of safety and security that I have, go 100% into owning rental properties, because I see the full picture, and the full picture includes home price appreciation. So for those who have been paying attention to our property evaluations, we added this line here not too long ago. I know Lee Bishop picked up on it in one of our shows. And he said, hey, Greg, why do you have this appreciation rate here of 0%? And, it's an effort for us to be able to help people see the bigger picture when it comes to home price appreciation. So the bigger picture for home price appreciation in Jacksonville is that since 1991, we've had our homes appreciate on average each year at a rate of 4.3%. And when you're looking at home price appreciation, if you are in the investment for a full market cycle, history shows us that home price appreciation rates tend to repeat themselves in a certain market. So a market cycle is 10 to 20 years. So if you go back to since 1991, and this is coming from the Federal Housing Finance Agency, if you go back that long, that is the historical average home price appreciation rate. And if you're making an investment decision today and you plan to hold on for 10 or 20 years, you can now count on home price appreciation, and you should factor it into your overall purchase decisions. All right. So knowing that, you know what? I was looking at the camera. I didn't even see that you were wheeling and dealing and put that number in there, right?
You said 4.3. I put in 4.3, right?
There you go. If you wouldn't mind, yeah, zoom in a little bit. Like, look at what this does to your overall returns, right? Now, Pablo, let me ask you. All right, we just went up 4% per year, but our return on investment went up from 11% to 26.5%. How did we do that if we only went up 4% a year in appreciation?
I would have to assume that it's either some kind of compounding effect or it's the ancillary effect that the appreciation has on all the other profit centers.
I love that you don't know everything about rental properties.
I know so little.
I love working with you, brother. I am bringing you along. And I'm glad that you didn't know that answer. Because not many people get this. This is so critical, right? The reason is about using leverage. Okay. This is one of the reasons why using smart, responsible leverage is so important, especially now. You heard me earlier say that I think there's going to be more generational wealth created right now compared to any other time that you can come up with in the past. It's because of what you're seeing right here. So when you have an asset that appreciates 4% a year and you own it in cash, meaning you bought it with cash, you did not use any debt, what is your appreciation? What is your return on investment for that appreciation, Pablo?
I was chatting with Marilyn in the chat.
All right.
She said she loved me in the chat, so I had to respond. I'm sorry.
You've got let's do this. You've got a property that is $100,000 property. We're gonna keep it simple, right?
Okay.
$100,000 property. You own it. You paid $100,000 for it.
Mm-hmm.
Okay. It then appreciates 4% in a year. It's now worth $104,000. Okay. So it earned $4,000 in value, and your initial investment is $100,000. 4,000 over 100,000 is a 4% return
Correct.
on your money, right? So when you own the property with cash, when you buy it with cash and the value goes up 4%, it appreciates 4%, your return on investment is 4%.
Yep.
Okay. So it's a factor of how much did the asset value go up over what was my initial investment.
Got
All
it.
right. So now, okay, that same property, $100,000, it goes up 4% each year. All right. At the end of the first year, it's worth
104,000.
104,000, right? You generated $4,000 worth of return from appreciation. All right. Let's assume that you made a decision to use smart, responsible debt, smart, responsible financing, and you put 25% down. Okay. For everybody who's following along at home, use your phone right now or wherever your calculator is and put $4,000 as your numerator and $25,000 as your denominator. 4,000 divided by 25,000 is a 16% return on your investment from the appreciation. Okay.
Leverage. Got it. All right.
Leverage, baby.
There it
Leverage.
is.
All right. And the other big thing. All right. So, you know, our mentality here at JWB is that number one, you got positive cash flow. But after you get to positive cash flow, you need to look at all profit centers, including home price appreciation, right? Let's take that 4.3% appreciation rate out of this. Okay. Our returns from just the cash flows and the other profit centers is 11%. When we put 4.3% there, it goes up to roughly 27%. Okay. Which is the bigger impact on your total overall return on investment? Those other profit centers or home price appreciation?
Home price appreciation.
Home price appreciation. So what people are missing by going to some of these other low-priced cash flow monster, markets out there, Cleveland, Kansas City, right? Yeah. Some of those markets out there, they get infatuated with the cash flow numbers. And I understand that that's fantastic, but they pay no attention to long-term growth. And what we're looking at right here is why you need to focus on both. You need to focus on positive cash flow, which you get in Jacksonville, but you need to be in a market that's going to grow. If your horizon is to hold on for 10 or 20 years, what we're looking at right here is why your overall return on investment will be a lot higher when you're in a neighborhood or in a market that has both, right? If you only focus on cash flow, you may get, it might, instead of 11% here in Jacksonville, you may get 13% somewhere else, but you might get half of the appreciation growth. And overall, your total returns are going to be lower when you hold on for a 10 to 20 year hold.
Got it. Yeah. So I just did that, right? So if it was half the appreciation growth, you go from 18, you go down to 18.2% as opposed to what you would have had at 4%, which is 25%, right? So like you lose 7% return on investment based on the appreciation. Interesting.
Exactly. I beat up on Cleveland a lot because I'm a Pittsburgh Steelers fan, and that's in our DNA is to beat up on Cleveland. And Cleveland's an easy target because home prices just don't appreciate there. Since 1991, their average appreciation rate's 2.3%. But their cash flows are better, right? Their cash flow returns are better than what I'm putting in front of you at JWB. So why do I still think this is the best investment for you? If you have a long-term horizon, it's because of what you just talked about right there, right? Their 13% return with 2% appreciation, like Pablo just showed, is less than 11% from cash flows plus 4% appreciation over the long haul. And that's why I love what I do here in Jacksonville.
I can tell by your face you love answering these questions. So we have a question from Marilyn here in the question spot, which is this the best home in the neighborhood? And I want to dive into the neighborhood, but I don't know if you can answer that right now. Like, is this the best home in the neighborhood?
So new construction for us is, you should think about it just being, it's not a new construction community, right? These are homes that are largely built in the 50s and 60s. And then we go in and we build new construction in that community. So if you're looking at it, is this the best home in the neighborhood? This is one of the only new construction homes in the neighborhood. So it does look very nice, right? It does look better because it's brand new than other homes in the neighborhood. Now, I know what a lot of you are thinking. what you've been taught is that you should never be the nicest house on the block, right? When you're making a rental property investment decision, right? Because you're assuming that the return on investment for that won't work, because you're assuming that you're paying higher for that property. The price of that is too high. You're assuming because the house looks good, the price is high, and ultimately the return on investment would not be as high. So my counter to that is, if your return on investment is your number one priority, start there. And be happy if your home is not new construction. And if it is new construction and others are not, there's certainly nothing wrong with it. But it all starts with your return on investment decision there.
Okay, makes sense. And now that we're on that neighborhood, Greg, I remember you when we started to talk about this project, you were telling me that, not this project, this property, you were telling me that this one's on a busy street, right? Like,
Yes.
Can you tell me a little bit about the dynamics of being on a busy street versus being on like in a cul-de-sac or something when it comes to rental property investing?
Yes. So this is on a busy street, right? And so many people say, well, how do you feel about investing in a rental property on a busy street? Again, for me, it comes back to the return on investment, right? The rents that I get on that road must be high enough to make it a compelling return on investment. And obviously here on San Juan, we just finished talking about that. So you know that that's a pretty high rent. And so when I look at busy streets, it is another factor that has some positives and some negatives. And really what this comes down to is, how well are we going to be able to get this home rented? What rent rate are they going to pay? How long are they going to stay? And so when you have a busy home, it is something that you're going to put a sign out there, you're going to do your online advertising, and you're going to get a lot more eyeballs that see that house. You're going to see more attended showings, which is going to lead to that house probably getting rented. I won't always say quicker, but the ability to rent homes that are on busier roads it's a little bit easier to do that. So advantage there. Now, are you going to appeal to everybody, right? If you're a family that has young children, who has pets, are you going to appeal to somebody that might be on a busier road? The answer is no, right? So you're going to get more eyeballs, but some are going to be turned away. And at the end of the day, it really doesn't matter for me. I own homes on busier roads. And I was pulling up some of the roads that we have. And again, all of you can kind of follow on home. For those of you who know how to use Google Maps, you should look up the street on the west side here on Jacksonville, Wilson Boulevard. That is another home that is just like this one on San Juan, where we've had a lot of success building homes, renovating homes, managing homes, renting homes on a busy road. I looked at it. We have 11 houses on Wilson Boulevard here in Jacksonville. So the cool thing is that we have a lot of experience doing this. We know exactly how to rent it out. And if you feel confident that you can achieve a high rent rate, which we can, and that you know how to rent houses, whether they're on busy roads or not, and you can appeal to those people who are looking for one or the other, then there's no problem with being on a busy road. You just have to make sure that the rent rate takes into account that you are on a busier road. And that's what we do.
All right, great. I've got a couple more questions. I'm gonna pop the property eval back on the screen because they relate to that, right? But first, Rick Williams asks, would you expect higher vacancy rates for homes with rents at the upper end of the range?
Great question. You know, when I say it's at the upper end of the range, that's the upper end of the range for JWB, right? That's not the upper end of the range for overall. Okay, so our sweet spot, our average rents are about $1,200. And so our sweet spots for rents are, call it, you know, $1,000 to $1,500, $1,524 in this case, right? Somewhere around there. So that's our sweet spot, just because when you go too much higher than that, the purchase prices of those homes skyrocket a lot more because there's more demand for owners in those neighborhoods. So that's really kind of why we stick to the sweet spot. So there are other rents. I mean, you can get rents in $2,500 range. I mean, $3,000 range per month. I mean, if you go to certain neighborhoods in Jacksonville. So I don't want to give the impression that this is on the high end of rents in Jacksonville. This just happens to be on the high end of rents in our sweet spot. So, and anything that's in our sweet spot, we feel really good about keeping residents long-term. So short answer to your question is no, I don't have a concern about keeping a renter who signs a lease at $1,524. That isn't a concern. Whereas if I was talking about a house that was rented for $2,200 a month or $2,700 a month, I might have more of a vacancy concern because there's less renters in that pool of demand there.
Makes a lot of sense. Eddie Harris has a question. Let's take a look at the non-recourse financing with this property. Do you lose the tax benefit there?
Oh, great question. So the answer is yes and no. We love those answers, right? So non-recourse financing is synonymous with buying properties in your retirement accounts. I guess in theory, you can use non-recourse financing to buy rental properties outside of your retirement accounts, but I haven't seen it done yet in all the properties that our clients have purchased. So when you see non-recourse financing, which is that middle thing, probably you want to zoom in a little bit more there so people can see what we're highlighting there. Yeah, there you go. That 188 a month. And, let's take that appreciation rate out of there, Pablo, if we can. Yeah. So non-recourse financing, synonymous with buying in your retirement accounts. Well, when you're buying properties in your retirement accounts, your tax savings are already built in. If you're buying it in a traditional IRA, that is tax deferred. That means that the income that you earn from rents, you don't have to pay taxes on while it grows. Eventually, later down the line, you will pay taxes on it, but it's that tax deferred growth that you're looking for. So the answer is yes, you have those tax savings. It's because of the vehicle that you're buying in. Now, do you get an extra write-off from depreciation within that vehicle? The answer is no. You don't get to take an extra write-off on that because you've already got what you were hoping for, which is tax deferred growth.
All right. Easy peasy. Marilyn Cotterman asks, is this home already leased?
Is this home? No, this home is not already leased, which is pretty common, right? We built this home. I think we released it, I don't know, a week ago, maybe 2 weeks ago, on the rental market. So we're really good at renting homes. We don't always rent them out within 7 days or 14 days. And so when clients come on board and buy properties with JWB, we tell them, listen, we are here to make sure that you are cash flow positive on day one. And by the time that you close on this house, you're going to have a tenant in place, a resident in place, and you're going to be positive cash flow. But there's a lot that we do from the time that a client puts the house under contract until the time they close on it. So there's generally about 45 days from the time that a client puts the house under contract until we close. And the whole entire time we're marketing it for rent. I mean, you guys could go online right now and search the address 5032 San Juan, and you would see that it'd be on Zillow and some of these other sites for rent, right? So generally speaking, when you put the house under contract as a JWB client, it's not going to have a resident in it. It's very normal. And again, we get it rented by the time we close. And that's why we come very, very strong with you and tell you, you should not expect vacancy cost right off the bat when you buy a JWB property. We're that confident in it.
Excellent. Guillermo Montes has a couple of questions here that I'm going to ask. He asked, first, how many new construction homes do you have available now, like San Juan Ave?
You know, I checked the full number, but I would imagine we have, I don't know, maybe 3 or 4 or 5, somewhere around there.
Okay. And then I think you're going to enjoy answering this question. And by the way, I think this is last question here, so we can get you to your next meeting, Greg. But Guillermo Montes again asks, in some markets, good school districts are important for a good rental property success. How is that in Jacksonville?
I love that question as well. Gives me an opportunity to kind of give a little bit of a different perspective than what many investors kind of come to the table with. So a lot of investors say, I only want to invest in neighborhoods that have good school districts. And I ask them why. And they say, well, because I think that's going to lead to a long-term resident. And I think when there's a long-term resident, then I'm going to achieve a better overall rate of return. And I say, okay, great. So if you could get to a overall better rate of return with a long-term resident, would you be comfortable if it wasn't in a better school district? And I get mixed reactions because people are so tied to the fact of it needing to be in a good school district. Listen, the reality when you're investing in cash flow positive neighborhoods, it is so hard to find turnkey rental properties that are cash flow positive in a market like Jacksonville, right? Jacksonville appreciates at a rate that's higher than the national average, almost twice what it appreciates in Cleveland, right? And there's no perfect investment out there. So there has to be something that you have to give a little bit on, right? These neighborhoods are below middle income neighborhoods, which we are completely comfortable in. They're not low income. We don't want to go there, but they're below middle income neighborhoods. And that's our cash flow sweet spot. And they're great neighborhoods for cash flow, positive cash flow, and you still get to ride the wave of home price appreciation for being in a growth market like Jacksonville. But in below middle income neighborhoods, you are not going to see above average schools. It's just not going to happen. You're going to see below average schools. And so what we have built our entire property management business on is how can we achieve long-term resident stays, knowing that we are in below middle income neighborhoods with below average schools. And what we've been able to find is that we can do that, right? That's why we only sign long-term leases. We only sign 2 and 3 year leases, and 70% of our residents renew. So the model can work. You can get to the end result, which is long-term resident stays, but you got to let go of being in the best school districts if you want to be in a growth market like Jacksonville, right? There's always some give and take. There's no perfect investment out there. And if that kind of strategy aligns with your overall goals, Jacksonville's going to be a great market. What I also find is that a lot of people get really emotionally wrapped up in looking at a house or a neighborhood that they want to invest in rental properties, and they put themselves in the shoes of the renter. And I think it's really important to point out that you are not your resident, right? It's different, and that is okay, and it's beautiful because you're creating a wonderful living opportunity that is better than anything else this resident may have the opportunity to rent. Like, who gets to rent a brand new construction home, right? At an affordable rent, right? Just doesn't happen. So you got to be able to separate yourself. And a part of that means being okay with investing in a neighborhood that has below average schools. You know, nobody wants, you know, when I look at my own kids, I look at myself and I say, I wouldn't want to send my kids to a below average school, right? But I'm not my resident. And this is a better situation for your resident than they would have the opportunity to rent anywhere else. And you got to be able to separate that.
Yeah, I hear two things when you're explaining this, Greg. Like, I hear definitely the human element of like, well, I wouldn't want to live there, right? I also hear the idea that if you are, so let me gather my thoughts, because I just my brain just turned off. I don't know what's going on today, man.
It's all good, man.
Right. I hear the I don't want to live there, but I also hear the propensity to think, am I the property manager, right? Like if somebody is a property manager and they don't have the systems in place that you have, right? Like, they don't have these like long-term relationships with people. They don't not force, but only sign 3-year leases to their own detriment, which makes it harder to find new tenants. Then you're probably telling your client, no, man, you want them in this good district school because then they won't leave, right? Because they're expecting the school to keep them in, as opposed to your property management chops and your ability to find residents to do it, right? Is that kind of also maybe why they're going down that path?
That's maybe. But I think a bigger part is that they weren't there to set the return expectations with their clients. So like most property managers they didn't sell the property to the client, to the investor. And so they didn't say, you expect an 11% return. If you weren't there to deliver that expectation, there's a ton of ways you can keep your property rented without delivering that return on investment. So, you know, that's the way most property management companies operate. The job is to keep the house rented. They make more money when they sign shorter term leases. And then the school conversation, you know, I wouldn't say that they would kind of lead them in one direction or another, because the school conversation is just reality, right? You're in below middle income neighborhood. So if that property manager is managing a home in a below middle income neighborhood, you know, they should just be very truthful with their owner that these do not have the best school ratings, and that's okay. You know, so I think it's more about just not being there day one, giving the return on investment expectation than anything, which is the biggest difference between why we put our clients in these neighborhoods, why we sign long-term leases, right? That's why we challenge ourselves to sign long-term leases, right? We could buy investment properties. We could help our clients buy investment properties in above middle income neighborhoods in Jacksonville and sign 1-year leases and deliver negative return on investments from the cash flows, right? And that would be a liability to all of you. And we are choosing to not do that. It's not what I espouse. I think it needs to be cash flow positive from day one. So we have to overcome certain things that may hold us back in terms of getting long-term residents. Is it ideal to have a below average school rating? No, it's not ideal. Can you overcome that through effective systems, training, sales, marketing, all that stuff? Absolutely. And your resident can be there for a long time, which is why our average resident stays over 4 years, right? So
yeah, makes a lot of sense. You control the whole piece of the pie as a true turnkey company, right? Like you're not referring this to anybody else. You're not doing just one part of it. You control the whole piece of the pie, so therefore it becomes less relevant. That makes perfect sense. Another lesson in JWB operational prowess that I always admire so much. Greg, I want to send you on your way. We got 2 super easy questions for you to answer. Mike Parsons asks, what's the price range of homes you have for sale?
So our price ranges will be between 150 and 210,000. Your renovations will be a little bit on the lower end of the pricing. So I think, 150, maybe to 180. And your new construction will be 160 on the low end to about 210.
All right. And Zach Correa asks, any thoughts about expanding to other cities similar to Jacksonville's business model?
Hey, Zach, good to hear from you, my friend. The question about going to other cities, the answer is no. There's no thoughts to doing that. It's a different approach that we have versus a lot of other turnkey companies. And, everyone can be the right approach for that company, right? Our approach is that we love making a deeper impact here in Jacksonville. And why most companies feel the need to go to other markets is because they run out of inventory. And our approach has been to prepare for that years and years in advance. So we always have a 2 to 3 year runway of land or renovations that we have that will turn into turnkey rental properties. And we try really, really hard to be a few steps ahead at all points. So that allows us to make a deeper and deeper impact in Jacksonville while also having those investment opportunities for clients. So no, there's no dialogue of going anywhere else. It is about how can we be a few steps ahead here in Jacksonville and make sure that we can provide opportunities for clients and great situation for our residents and great situation for our team. We feel like there's a inherent risk to trying to spread yourself thin and going to other markets. And we just want to be the best here in Jacksonville.
Awesome. Zach puts here in the question thing, JWB has an awesome business model. Glad to be part of the family. Aloha, Greg. And Greg, I just want to tell you, you transitioned perfectly into our goodbye segment here and talking about Tuesday's call, right? Like you are going deeper into neighborhoods. You're going deeper into Jacksonville. I know that there is a sixth profit center, I'm struggling today, man. I think it's because we ran an hour earlier than we normally do. But anyway,
we did get up early this morning, brother.
We did get up early this morning. But there is a whole nother profit center that nobody ever talks about because nobody goes as deep as JWB, right? And that's the profit center of empowering and developing the neighborhood, developing the community, adding to the urban fabric. And who we have coming on Tuesday is Steve Wernick, who's a land use attorney who specialized in neighborhood redevelopment. And he's also a specialist in urban trails, which is another thing that's coming to Jacksonville that is going to significantly impact quality of life, real estate values, the urban fabric. The same way that we talk about why downtown is so important, Steve is going to join us on Tuesday to give examples of other cities, projects that he's been a part of, and how that's affected. And you're going to get to pick his brain on what other people are doing and how that comes in. I think it's going to be a really, really valuable conversation. So I hope that if you joined us today, I promise you that my tongue will move in accordance with how my teeth are moving and my lips, and I will speak much better on Tuesday. But Steve is going to be a really, really interesting, compelling guest, and you're going to get a lot out of that. And apart from that, if you want your own little calculator sheet that I've just been messing around with, go to jwbwebclass.com where you can get it. You can get the free investor toolkit. You're going to get the explanation on how different markets affect rental income property, what to look for, all the good things that Greg took a lot of time into putting together for you. You'll just be a smarter investor as a result. So I want to thank everybody that joined us today on Thursdays. Thursdays are our favorite day of the week because we have this like really casual back and forth. Again, your questions made this show possible. Thank you, Zach. Thank you, Guillermo. Thank you, Marilyn. Thank you, Lee. Everybody that's been contributing. And I'll give it up to you, Greg, to say goodbye to everybody else.
Yeah, I just really appreciate everybody being here. And, your feedback is really what is driving this show even more than the Tuesday show, to be quite honest, right? This is all about giving you exactly what you feel like you need to help your investing career, whether that is the chance to invest in additional properties or whether that's the chance to just kind of learn how this stuff works. So we love your feedback. If you're on social and you want to just drop a line in the Facebook group to me about the show, be great. These property evaluations that we're bringing up literally came from suggestions from you all. So we appreciate it. I think we're going to continue to do this on a weekly basis. And if anybody would like, for a current client, if you'd like to speak to your portfolio manager about this property, you can reach out to us. Of course, your portfolio manager's information, or just drop a line on social and I'll be happy to connect you guys.
Greg mentioned social. We've got an awesome Facebook group with over 1,600 people. Go to jwbfacebookgroup.com and you can connect with us all there and see Greg every day when he goes live in there in the morning. So again, thanks, Greg. Thank you all for being here, and we'll see you on Tuesday.
See you, everybody. Thank you.